ICICI Bank posted robust earnings in the first quarter of FY23. The second largest private bank's net profit surged to 6,905 crores in Q1 FY23, a 50% growth compared to the same quarter last year. Though operating expenses increased, profit growth was driven by market-leading loan growth, best-in-class margins, healthy fee income and significantly lower credit costs, even as the bank shored up contingency provisions during the quarter gone by. Moreover, unlike its peers HDFC Bank and Kotak Mahindra Bank that saw trading losses, ICICI Bank reported mark-to-market profit, though modest, on its investment book. Overall, ICICI Bank posted improvement on all fronts in Q1 FY23. The strong performance of the bank gets reflected in the stock performance. ICICI Bank not only delivered high returns compared to HDFC Bank, but has also outperformed Nifty50 and Nifty Bank in the past 1, 3 and 5 years by a wide margin. Remember, we had highlighted after Q4 FY22 earnings that ICICI Bank's valuation gap with HDFC Bank can get closed. ICICI Bank now trades on par with HDFC Bank in terms of valuation after having traded at a valuation discount to the largest private bank for most period in its history. Surely the valuation gap has also diminished because of the underperformance of HDFC Bank stocks for various reasons, management change, technical glitches, merger uncertainty, etc. But the real reason behind ICICI Bank catching up with HDFC Bank in terms of valuation is that it has better matched HDFC Bank on all financial parameters, be it funding profile, loan book mix, asset quality, provisioning buffer, capital position and most importantly, the margins. ICICI Bank's high earnings growth of 50% year-on-year in Q1, despite making 1,050 crores of contingent provisions compared to 19% of HDFC Bank in the same period, is very encouraging. Domestic loan book increased by 22% YOY, led by strong growth across business segments. Retail credit grew by 24% YOY, led by mortgages and unsecured book. Corporate credit too saw good traction. It increased by over 14% YOY. Overseas loan book also expanded by 14% YOY, primarily due to increase in the India-linked trade finance book. Now, deposit growth was healthy at 13%, was mainly driven by a 16% growth in CASA deposits. Growth in term deposits lagged behind at 11% year-on-year. Net interest margin on domestic book came in at 4.14%, which is best in class. As 70% of domestic loan book is linked to repo and other external benchmarks, loan yield should improve with rising interest rates. With 45% CASA book, the rise in cost of deposits may not be commensurate and will happen with a lag effect. Hence, there is scope for margins to improve further next quarter. Fee income grew by 32%. Surprisingly, the bank also posted modest investment gains which supported non-interest income. The lower duration of its AFS book and some equity gains helped report mark-to-market gains contrary to most other banks. Operating expenses increased by 25% year-on-year. Consequently, the cost-to-income ratio inched up above 42% level despite higher income. Going forward, operating leverage is likely to improve with higher thrust on technology and digital banking. Asset quality fared better. Net NPA ratio declined to 0.7%. Restructured assets too declined to 0.8% of advances book as of June end from 1% at the end of March quarter. ICICI Bank carries 31% provisions on restructured assets, more than the regulatory requirement of 10%. Now, thanks to improving asset quality trends, provisions declined even as the bank created a contingency provision of 1,050 crores in Q4, taking the total excess provisions to 8,500 crores. The strong provisioning buffer will help contain future credit costs and support earnings. Overall, ICICI Bank's Q1 performance reflects why once a poster boy for stressed assets today trades on par with Mr. Consistent of the Indian banking industry in terms of valuation. At the current market price, ICICI Bank trades at 1.9 times FY24 estimated core book value, which is attractive considering that ROA and ROE improved up to 2% and 15% respectively. Moreover, the bank's valuable subsidiaries continue to add shine to the stock performance. Given the clean and strong balance sheet with ample capital, the odds are clearly in favor of ICICI Bank for delivering strong earnings growth in the coming quarters as well. And with the improvement in equity market sentiment and macro environment, valuation multiple can re-rate further, driving the stock upside. Now, sector tailwinds in terms of improving credit growth and margin support from rise in interest rates should also aid stock re-rating. So with limited downside to earnings, ICICI Bank, according to us, offers best risk return in the banking space.